So welcome to this webinar. The title is Analyzing Investment Strategies with CVaR Portfolio Optimization in MATLAB. My name is Bob Taylor, and I'm a developer here at the MathWorks. The topic of this webinar is to try to answer a normative question, which is whether or not to implement a particular investment strategy. The strategy that we're actually going to look at is known as a covered call strategy. It's an old strategy. It's something that most people understand, so it's not particularly restrictive in the sense that if there are other types of strategies that you're interested in, what we're going to be showing today, you can apply to those strategies as well. A quick overview is we're going to start by looking at the background theory for covered call strategies. We're going to identify some issues associated with that type of strategy, and in particular, the issue of slippage. And then we're going to proceed to go from theory into looking at simulation to try to understand what some of these issues might look like in actual data. And so we'll gather some data, we'll do some calibration, simulate based on the calibrated models, and then generate scenarios, which will be used for portfolio optimization. And we'll actually use portfolio optimization to answer the normative question. And the way we'll do that is by comparing a strategy. We'll generate scenarios for a particular strategy, generate scenarios for an alternative, and then see how the portfolio optimizer chooses whether or not to implement that strategy. There are a couple of dense slides, and I won't be going through them in great detail. They're just here for informational purposes. This is just a brief history of covered call funds. They actually came about almost immediately after call options were listed in the 70s. And by the late 80s, they were actually some of the largest funds among mutual fund companies. The only problem with this type of fund is that they cap the upside. And so when you go into a bull market, these funds tend to lag. And so in the late 80s, there was a huge bull market, and these funds started losing money. The only problem is that they were marketed at that time as income funds, and that they were sort of conservative investments. And so a lot of fund managers started doing things like writing naked calls and doing some other things that were outside the strategy that actually made them lose even more money. And in some cases, they even resorted to Ponzi schemes. By the end of the 80s, these funds fell out of favor. And in the mid-90s, they were almost completely gone. They did come back after the end of the technology bubble around 2000. And they're now, today, Morningstar lists over 30 of these types of funds again. Another dense slide, but basically the idea of a covered call strategy is that you own an underlying asset, and in our example we're going to be talking about underlying stocks. And if you own that underlying asset, if you write a call on that asset, it means you sell the option to someone else to acquire that stock at what is called a strike price. And so if the price of the stock is below the strike price, it means no one will exercise that option because they'd have to pay you more to take possession of the stock. If the price goes above the strike price, then the person who bought the call option from you might exercise that option, and they'll essentially pay you a lower price to take possession of the stock. And so that's how a call option works. In the case of stock options, they're known as American options, which means that someone who buys a call option can exercise that call option at any time. So here's the first MATLAB script that we're going to start looking at. And I want to point out that all of the scripts that are shown today will be on MATLAB Central in the near future. And you can download them and do what you want with them. At the top level, there's a superscript which contains it sets up some paths, and then, because there's some source code associated with some of the underlying calculations. And then there are 6 scripts here, actually, that look at different aspects of what we're going to cover in the webinar. And since we're now looking at the theory part, this is the first script, which actually generates the plot that you saw. And what it's doing is, this is a typical textbook diagram that in any book on call options or other types of derivatives, you would see this type of diagram for a covered call payoff. So this is setting up all the features for a covered call, pricing the option. In this case, it's an American option. There are no dividends, so you can use Black-Scholes pricing. And if you select this section and run it, you get this standard payoff diagram. And the basic idea is the blue line is an uncovered position, which would be just holding the underlying stock. And in this particular diagram, you're starting with a stock price of $40. And if the price goes up, your wealth goes up proportionally. If the price goes down, your wealth goes down proportionally. If you write a call to cover the position, you get an additional premium because of selling that call. And if the price goes up, it moves along with the price of the stock. The only thing is, once it gets up to the strike price, which in this case is 42, at that point, if this is expiring at that price, any price above the strike price, you basically are just going to get, somebody will exercise the option and you'll only get 42 for the price of the call, so it caps your upside. And this diagram shows that for a drift, a stock price with a small drift, which at the end of this expiration period, your expected price would be here, and this would be a profitable position relative to the uncovered position. If you're in a bull market where prices are really moving or there's a huge rally, you have a much higher drift rate, meaning the rate of return on the stock price. And in this case, this would be your expected terminal price, and you can see that the covered position actually would fall short compared to the uncovered position. Now that script also generates this is another textbook type diagram, and the main idea here is that this is the distribution of returns for an uncovered strategy if you were to do a Monte Carlo simulation. And this is a typical log normal payout. And this is what you would see for a covered strategy. So you can see first that there's no probability of any price going above the strike price, and that this is definitely not a normal distribution. So in order to go from sort of textbook theory to starting to look at what's going on here, we need to come up with at least some assumptions. And some of the more realistic features would be, the most obvious thing is at the market level that you have rational investors. The main thing here is that even though you can exercise an American option at any time, a rational investor would never exercise an option that's out of the money, meaning that the stock price is still below the strike price. An irrational investor would pay more to buy a stock at a cheaper price. There are two assumptions regarding the underlying, which is the stock. One is that it's a geometric Brownian motion is a good description of the movement of prices. And in this particular example, we're going to not have dividends. It's another layer of complexity. It's not that hard to add, but it makes the analysis a lot slower and a lot more complicated. And it's not a major issue, actually, for this particular analysis. As far as the options are concerned, they're American options. And since we're going to be setting up portfolios of multiple stocks, all the options on any of those stocks will have a common expiration date. And then if there's expiration occurring at some point, the next expiration date will also be common. And then finally, there's some restrictions on just the strategy. The first is that you can't have naked calls. And that means that you have to own the underlying stock in order to write a call option. And that's usually a requirement, especially in a fund. And it's actually a very dangerous strategy. The second is that you can't roll over calls, meaning if you have a call and it looks like the stock is moving in a way that it might get exercised, you would buy the call at the same strike and expiration and then write a call at a higher strike or a longer expiration. That's a very costly strategy, and it actually has a lot of risk associated with it. You could add this, however, if you wanted. The final is that you can't have recursive calls, which means if you write a call, you get the cash for selling the call. You can use that to buy more stock, and then you can write more calls on the stock that you bought and keep doing that. You can actually do it 3 or 4 times, but again, it's not a very good idea. Now, one of the most important ideas in investment management is the idea that you have to put your capital to work at all times. If you looked at our diagram, that was showing the life of a particular instrument. But in fact, in reality, you have to keep putting your capital to work. And so it's better to look at the strategy in terms of a fixed period of time, which is called an investment period. And the idea there is you pick a period of time which is a natural period for which you'd measure performance. So for this type of strategy, typically it would be a 1 month period or even a 3 month period. For other types of strategies, it could be as short as a day or even shorter periods of time. But the main idea is you're picking a period which is a natural point where you're actually checking to see how well you're doing. And throughout the rest of the simulation, everything is in a 1 month investment period. So at any time during one of these investment periods, you have the possibility of someone, if you have a covered position, that someone may exercise that call. And when that happens, you get what's called an assignment. And if you have an assignment, then you lose the stock that you hold and you have to reinvest because you have to keep putting your capital to work. What we're actually going to model here is that there are a number of events that occur when this process takes place, and there are a number of possible delays. I mean, the first is that there's a notification of assignment delay, and once you get that notification, then you have to deliver the underlying stock at the strike price, and you receive the strike price in cash. Now that you have the cash, then you can use that cash along with any cash from the call premium when you sold the call to reinvest in the underlying stock. That reinvestment process, however, has delays, and in fact it has opportunity costs. And in the large mutual funds in the 1980s, a lot of them got in trouble because of this, because they had such huge positions that would get assigned. It would take them as much as a week to get back into their position, and the costs were just horrific. Finally, the investor has to wait for the stock to settle. In the U.S., that takes 3 days. You can't write another call until the settlement occurs, and so it's only after settlement that you can write another call on the underlying. Once this whole process is complete, then what happens is you're in a new covered position in the stock. Now, if you think about all these different delays and these different costs and opportunity costs and frictions and so on, it implies that there's a kind of slippage that takes place. And slippage is really the aggregate difference between the strike price that you received at assignment and the price it cost you to get back in. If slippage is 0, then obviously you're giving up the stock at the strike price and you're able to get back in at the strike price, so there's no real loss. If slippage is greater than 0, then you're actually, you're paying more to get back in, and that has a negative impact on performance. And slippage can be negative as well, which would mean that you actually came out ahead to get back in. The key variable, though, that dictates what slippage is the probability of early exercise. And the theory says that no one, even with American options, would be expected to exercise an option until expiration. The only problem is that it actually does occur, and it occurs quite frequently. There are a lot of plausibility arguments in a number of papers that have tried to argue why this might happen, but it turns out there's no real theory to explain this, and there's no theory to model what early exercise probabilities would be, or how there are actually no empirical papers on this. One of the ways of looking at this, however, is that early exercise is probably due to agency considerations, and this is where you're getting into behavioral finance. I mean, 2 examples are liquidity. If you want to gain liquidity in a thinly traded stock, for example, you might essentially purchase a call option, and if it starts moving in the direction that you'd like, you can exercise that option. And that's actually frequently done. So this second example is the use of cash, that if you have a position in a call option, it might make sense to exercise the option because you have a better use for that cash. And because, the time value of money might make it worth more today to put it to use than to wait until exercise. Now, here are 2 different ways of looking at the maximum allowable slippage that would make having a covered position a bad idea. One is if you're initiating a position in a call during the investment period, you're getting the call premium, and this is the upper bound for slippage. I'll actually illustrate this so you don't have to worry about the formula in particular. The other is if you have an ongoing position where you already have a covered position when you come into an investment period, and this is the maximum allowable slippage before a covered call strategy becomes unattractive. The difference is mainly due to the fact that if you initiate a covered call during a period, that call premium contributes to your total return for that period. If you have an ongoing position, you don't have that call premium. Okay, so rather than going through these equations, I'll show you some graphs that you can generate from MATLAB using the theory script that we had looked at earlier. And this shows slippage for the two different types of cases, one for the initiating position and one for the ongoing position. If you look at, this is a plot where the stock price when the call was written is 40, and so you're seeing strike prices that go from at the money to out of the money. And you see on this axis the exercise probabilities, and at 1 that means 100% chance that the option is exercised when it gets at or in the money, and then it goes down gradually to 0, which would mean that there's no chance of exercise, prior to expiration. If you look in the initiating position, because you're getting that call premium, the maximum amount of slippage, which is anything below this surface, is on the order of hundreds of basis points. So that's pretty forgiving. You can actually have a lot of slippage, and you'll still you would expect that you'd be able to do pretty well. The red line is actually a heuristic model that I have, and it's in the code, which, given a strike price, it's actually figuring out the hitting time probability for the underlying GBM process to hit that strike price, and using that as the exercise probability under an assumption that as soon as you hit that strike price, you would then exercise. So this gives you kind of an idea. This triangular region here is probably a pretty good idea of where the real maximum slippage would be. But you have to realize that there's no model for either the exercise probability, and we really don't know what that slippage might actually be. In the case of an ongoing strategy, this is much different. Again, we're looking at things in terms of basis points, but now you're looking at slippage below 5 basis points, and in fact below 1 or 2 basis points. Now that's an extremely strict upper bound, meaning that if you slip any more than 1 or 2 basis points, this becomes an unprofitable strategy. So this suggests that there might be some problems with this strategy. If we look at the historical performance for this type of strategy, the CBOE developed an index actually in the mid-'80s called the S&P 500 Buy Right Index, or BXM, and it's a rule-based covered call strategy that's similar to the one that we're looking at. And if you look at two different historical periods, the first is the life of the index, and the second is a 15-year period, which is consistent with the period that we're going to be looking at. You can see that there's not much difference between the index and the performance of the S&P in both periods. I mean, in one case it actually underperforms, and in another case it slightly outperforms. And the only major difference is that the standard deviations are a little bit lower. But what this is suggesting is that this is not giving you any kind of free lunch. So we've raised some issues by looking at it at a theoretical level. So the next step is to do what is essentially this normative analysis. And the idea of a normative analysis is you're trying to answer the question, ought you do something, rather than what you need to do. It turns out this is a much more powerful approach than just backtesting or simple simulation. And the reason is backtesting, it's good as a reality check, but since you're only looking at a single realization of a process, it's not really telling you anything about how well it might do going forward. And it's neither descriptive nor normative. Simulation is a little better because you can run lots of simulations and look at the results, and you can sort of look at things within the particular strategy that you're interested in, but it's not normative because it's not telling you whether you should even be doing the strategy in the first place or not. If you incorporate optimization into the simulation process, however, it gives you a way to answer that normative question, which is whether to use a strategy or an alternative. And the way you do that is you set up both a strategy and an alternative, and you let the optimization decide which is preferable. In this case, it also accomplishes other things. With optimization, you can optimize over all risks. You have better risk diversification, and you have better tactical positions with better trade-offs. For example, in this case, if you have covered and uncovered positions that you're looking at within the optimization, it's likely that you're not necessarily going to cover all positions or have all positions uncovered. You may have mixtures and so on. So this gives you a better way of utilizing an investment strategy. This can be used by different types of financial professionals on the sort of analyzing strategy level. Traders and analysts can use this. At a larger level where you're looking at whether or not to implement a particular type of fund, or you're involved in oversight or due diligence, fund managers, risk managers, and managers of fund managers can use this kind of tool to decide whether or not the strategy makes sense. And the final area is that regulators can use this, because a regulator can, if somebody describes a particular strategy, a regulator can basically look at doing these kinds of analyses to determine whether that strategy is really making the kinds of payoffs that they might be seeing out in the market. So our normative analysis essentially has the following workflow. We're going to get some data. We'll then calibrate stochastic processes for that data and then simulate them, and then use that to simulate scenarios. And scenarios are a jargon that are used in stochastic optimization in particular, but the idea is that what you're doing is you're generating, in this case, returns from the underlying distribution of the strategy and processes involved with generating portfolio returns for a period. In this case, we'll be generating 20,000 samples of scenarios for 26 stocks. And when you generate a scenario, you're actually implementing, you have event loops and model delays, and there are all kinds of costs and frictions, some of the delays of assignment, for example, which we'll be modeling. And you can make this very parametric, which means you can try looking at different sensitivities to different effects. We then generate scenarios for both the strategy and its alternative, and by combining them, we then pass them into our portfolio optimization tools. And we're actually going to use both CVaR portfolio optimization, which is conditional value-at-risk optimization, and mean-variance optimization. And then we'll examine and compare the results. So the data are essentially data for 26 stocks with 15 years of daily data that I downloaded using the data feed toolbox. And I actually formed total return prices. And you can see here the distribution of risk to return and the symbols for these 26 stocks. This is another dense slide, but basically we're assuming that that the underlying stock price process is a geometric Brownian motion. And what we're actually going to do here is something a little different than what is usually done. In this case, we're going to do maximum likelihood estimation of the continuous parameters using discrete observations of our stock price process. And in this case, you get an initial price, you get a drift vector, and a diffusion matrix. And one of the features of geometric Brownian motion processes is that the log of the continuous price process has finite dimensional distributions that are normally distributed in this form. These are actually the inputs that go into the option pricing models that everyone works with. The alternative that people tend to use is to just take returns and calculate the mean and covariance of those returns. That's not a maximum likelihood estimate, however. So if we go back to the code, the calibration step, there's a script that does that. It loads in the stock price data, and in this case, it's stored in a financial time series object. We have 15 years of data, and these are the series that are in there. And then the calibration process, it actually calls this function, which will be in, if you download this from MATLAB Central, this is a maximum likelihood estimation for the process. And if you run this, This actually runs pretty quickly. And these are the parameter estimates. These are the initial prices. And the initial price is a price prior to the first observation. And the drift parameter is here, and the diffusion parameter is derived from the diffusion matrix. The script also plots what these calibrated processes look like. This is the drift. This is the underlying actual price process, and then this is the one standard deviation band for the growth of that process. So once we have calibrated the model, then we can start simulating scenarios. And the scenarios are total returns for covered and uncovered positions sampled from these underlying distributions. The first thing is we simulate stock price process with the GBM object and this SDE simulate method in the financial toolbox. That generates the underlying, and then we're going to simulate scenarios for the covered call strategy and then for the uncovered alternative strategy. In this case, because we're going to use optimization to decide whether to use covered or uncovered positions, we don't need to have a coverage parameter in the covered call position. The optimization will decide whether that's true. Some of the practical issues with this is that this is very slow, and it would actually be better to use the parallel computing toolbox for this, and that there are huge memory requirements. So here's a script which actually looks at a single scenario, and there's a lot of inputs that set up things like your investment position, the features of your calls that you're writing, some of the costs and frictions involved, some of the delays that you might experience. But there are basically two functions that generate the scenarios. The first is a function that generates the uncovered scenarios, and what that is actually doing is setting up your initial position in terms of the number of shares. You're giving it your initial wealth, and then it figures out from that how many shares you have and how much cash you have left over. It's trying to make a valid attempt at using integer numbers of shares and so on. It then sets up certain output variables, and then there's a time loop. And in the time loop are all the different things that might occur during this single investment period. And in this case, the investment period is a 1-month period from start to finish, and the return over that period is a single scenario for the uncovered position. So during that period over a month, for example, each day, in this case, you're accruing interest on the cash account at the end of each day. So it's checking to see if that happens and does the accrual. If you have enough cash at some point, it'll actually purchase more stock in the position, and then update your test variables. At the end of the period, if you're paying out a distribution, which actually happens in a lot of cases, if you're running a mutual fund, for example, it figures out how much cash that you need, and then if necessary, it'll sell the stock that needs to be sold to be able to make that cash payment, and then it calculates what your total return is for the period. Now, in the case of the covered position, that's much more complicated and in some ways more interesting. In this case, you're getting the underlying geometric Brownian motion process for a particular stock to generate the scenario, but then there are all these other inputs that are associated with the strategy. And the main thing that's happening here, it's the same type of architecture where you're initiating your position. In this case, you're setting up the call option, and if you have an ongoing position, the option is already there. If it's not, then you purchase an option, and then you have another loop. But in this case, you have essentially several states that you might be in, and this is using just logical variables. There's a variable that determines whether you're in assignment or not. If you're in assignment, then there's the first confirmation step, which is actually the amount of time it takes to be notified of an assignment, and then delivering the shares and receiving the cash. Once that state is complete, then you have a reinvestment state where you start reinvesting in the stock. In this case, you're laddering back into your position, and so there's a countdown that occurs. And then once you've reinvested, then you have to wait for settlement to occur, so then it essentially delays at each tick of this simulation. And then once settlement has occurred, then you can write a new call option. In this implementation, it's actually using what is called a strike cushion. In this simulation, it's 5%, which basically means that whenever you write a call option, it's 5% out of the money, or 5% above the current stock price. So then it writes the call, and if expiration occurs, there are some other things that happen, and then assignment is done. If you have a covered position, if you're not in assignment, you have a covered position, and so if the stock price goes above the current price, then it computes what the likelihood of early exercise might be. And there are two different models that we're looking at here. One is a heuristic model based on moneyness, which is this part, and the other is basically an explicit probability that you just use as an input, and it figures out what the likelihood of during the particular period that exercise probability would be. Then it basically generates a random number to see whether or not that early exercise occurs, and if it does, you're back in assignment. Finally, there's a check for contract expiration, and if you need to roll to the next contract, because if the option's in the money, it gets exercised, so you have to essentially write a new option. And then there's interest accrual on any cash accounts at the end of each period, at the end of each day. And then finally, there's a distribution, again, if you have to raise cash to distribute. And because there are two different ways of looking at your positions, if you're initiating a position in the call, then you calculate return relative to your uncovered initial wealth. And if you have an ongoing position, then you calculate your return relative to your covered initial wealth. So this script basically shows one of those examples. Okay, here we are. All right, so this is an example for a single scenario, and the green line is the uncovered position. Essentially, this is your initial wealth, and after a month, which is 22 days in this case, this is what the scenario would calculate as the return over this period. The covered position in this case doesn't have a lot of slippage. It's also showing the number of shares you have in the covered position, your cash position, which in this case is just incrementing upwards by the interest that you get at the end of each day, and this is your strike price. But if we run this again, here's an example where we're looking at exactly the same underlying process in this case, but in this case early exercise occurred, and you can see there's a huge amount of slippage in this instance. And so what actually happens is you have 25 shares up until the assignment occurs. Then you give up all those shares, so you have 0 shares. At the same time, you have this amount of cash from the covered call premium, and then you jump to get, because you've received the strike price for the stock that you had to deliver. Then what happens is you're buying to get back in, and this actually takes a day to get back into the stock position, but now you have fewer shares because you didn't get as much, because of the slippage essentially ate up the difference, and you can see that your cash position goes back down to almost nothing. If we run a few of these, you can see sometimes you get exercise, sometimes you don't, and here's an example. You can see this more clearly, that here's a settlement period, and that then you can write another call, which at this point is now at 49 rather than 42. And so in some cases, even with this particular example, you can actually have early assignment happen twice in a period. So there's another script here, which is the actual script for generating scenarios, called CVaR Webinar Scenarios. And this basically loads in your data. It does the calibration step within the script. It then generates the multivariate GBM process for the underlying, and then sets up your simulation. And what's happening here is it's actually generating 20,000 scenarios, which are samples from the underlying distribution of asset returns for your 26 stocks. And it's actually generating returns for an uncovered position, for a covered position with a 5% strike cushion, and a covered position with a 10% strike cushion, and then saving it to a MAT file. Now, if you download this from MATLAB Central, you should run this right away, because this file is not shipped. You have to create this file to do a lot of these scripts, and it probably would take a lunch hour to do this. So we're not going to run it right now. And here's an example of the distributions of these scenarios. These are initiating positions where you're writing a call during the investment period. These are ongoing positions where you already have a covered call. These are the uncovered portfolios, and it's hard to see, but these are pretty much log normal distributions as you would expect from a GBM process. In this case, though, the covered positions are definitely not normal, and we can actually see that by doing a Lilliefors test, which is in the statistics toolbox. And if you run this, and there's actually a script that is included, but we won't run it just in the interest of time. If you run it on the uncovered positions, the null hypothesis is that these returns are normal, and you get a test statistic that basically says you can't reject that hypothesis at the 5% level. However, in the covered positions, almost every single asset, you get some exceptions, but across 26 assets, it's usually 24, essentially give you a test statistic of 1, which rejects the null hypothesis, which essentially concludes that these scenarios are definitely non-normal. So now, once we've generated these scenarios, we're ready to do the portfolio optimization. And we're going to do mean variance and conditional value-at-risk optimization. There's another script, which CVaR optimization. And what this does is it loads in your scenarios. And those scenario files are 20,000 by 26 matrices of uncovered scenarios and covered scenarios. And if you want to have multiple call different strike prices, you can uncomment this section and have both of those in there. It then sets up 4 different types of portfolio optimizations. The first is to do CVaR portfolio optimization. And here it creates a portfolio CVaR object and specifies the asset list, which is identifying covered and uncovered positions in your universe. Then it uses the set scenarios method to put the scenarios matrix that you've created here into the object. It sets default constraints, which are in this case that the weights have to be greater than or equal to 0 and sum to 1. You can implement any other types of constraints that you want, of course, with this object. And it sets a probability level, which is actually, in this case, I'm using 0.9, which is a typical value. And the idea of the probability level is that you're specifying 1 minus the probability of loss greater than the value at risk, which is essentially the piece of the tail that you're going to try to minimize using CVaR optimization. And that's all you need to set up the object. And once you've set it up, then the estimate frontier method will estimate portfolios from the bottom to the top of the efficient frontier. And then given those portfolios, you can calculate the portfolio standard deviation of returns, the portfolio return, and the portfolio risk, which in this case is CVaR. Side by side, we're going to use the portfolio object to also do an optimization on these scenarios. In this case, you can pull the scenarios from the CVaR object and pass it in to the estimate asset moments method of the portfolio object to give the portfolio object the mean and the covariance that it needs. And then again, set default constraints, compute the efficient frontier portfolios, and then compute the standard deviation returns. As a basis of comparison, which is our alternative to, we also do a mean variance optimization on just the uncovered positions and compute the portfolio weights, standard deviations, and returns. There's a final optimization, which we'll see in a later slide, which if you're given the standard deviations of the portfolios from the CVaR optimization, we can use the estimate frontier by risk method of the mean variance portfolio object to match the standard deviations that we've input to produce mean variance portfolios that have the same standard deviation of returns. So if you run this script, and this takes a little bit of time, it generates a number of plots that illustrate the difference between mean variance and CVaR portfolios and how they look when you match risks, and then it looks at the efficient frontiers, and then it lists the portfolios. So if you run these optimizations, these are the kinds of results that you get. If you look at initiating portfolios where we generated scenarios that in which you're writing a call option for the period, these are the kinds of portfolios you get across the efficient frontier from the bottom to the top. I'm using the heuristic exercise probabilities that were in the scenario generation engine, and it turns out that they're almost always the same. All the portfolios pretty much have the same type of look to them, and in fact the mean variance portfolios are very similar too, except at the bottom. The main feature here is that it always comes up with covered portfolios, and there are different degrees of diversification depending on which end of the efficient frontier you're at. This is illustrated more clearly if you look at an area plot of the portfolio weights. You can see these are the reddish bands, reddish to yellow bands are essentially covered positions, and the bluish to greenish bands are uncovered positions. And so if you have the exercise probability at all less than 1, meaning early exercise occurs with a probability of less than 1 during the investment period, you essentially get covered portfolios from both mean variance and CVaR. If the exercise probability is 1, the mean variance optimizer comes up with some uncovered positions at the bottom end of the efficient frontier, which is the low risk end. But CVaR also gives you essentially fully covered portfolios. If you run the same optimizations on scenarios where you have an ongoing position, and remember in this case the maximum allowable slippage is very low, again using heuristic exercise probabilities, you get fairly similar results for any of these probabilities, and the mean variance portfolios are also very similar. And the main thing that you see here is that above, at the higher levels of CVaR, these are fully uncovered portfolios, and it's completely rejecting any covered positions. And it's only at the low end of the efficient frontier that you're seeing any kind of covered positions. And in just a few instances in this particular example, and you can see it's usually like this, you see some partially covered positions, like Raytheon has both an uncovered and a covered position, and also ExxonMobil. This is illustrated in the same way, where if you have a probability of early exercise less than 1, the bluish and greenish area bands are uncovered positions. What you see is very strongly that the optimizers are going for the uncovered positions, and it's only at the low end of the frontier that you start seeing some covered positions. If the probability of exercise is 1, you see more covered portfolios. If you recall, the way this simulation tool was set up, we also looked at having 2 different strike prices at 5% and 10% out of the money. The CVaR basically favors call options with lower strike prices, and the reason for that is you get a higher call premium. And almost every one of the portfolios, if you were to run this, go through this, favor the 5% strike cushion. Mean variance actually incorporates a lot of the higher strike prices at the low end of the efficient frontier. So because we've run both CVaR and mean variance, and there are some differences that we've seen, there's a question about that. In some cases, mean variance efficient frontiers have lower risk and lower return portfolios than the CVaR portfolios. And you can see these uncovered positions coming in over the entire frontier. But when you match these plots for risk. In other words, if you take this standard deviation of portfolio returns and find the mean variance portfolio return that has the same level of standard deviation, that would be here. And then put these plots side by side, you end up with something that's very similar. So why is this different as far as mean variance is concerned? Well, one thing to keep in mind is that the low end of the efficient frontier, you're trying to minimize risk no matter what the return might be. You're not even concerned about return. And so what mean variance optimization is doing is it's just trying to find the best way of minimizing that risk, these are symmetric risks. And because we actually have non-normal returns, when you have a covered strategy, it's introducing some of these uncovered positions to, that have more symmetric risks and essentially going after what might be spurious correlations. So what you can conclude with this is that CVaR actually does a better job at managing risk in this case. It tends to do a better job when you have, especially the more non-normal your returns are, the better CVaR works. So here are the final results that we can draw from looking at all these different scenarios and different types of optimizations. For an initiating position, regardless of the exercise probability, initiating a covered call strategy is favored. These are the portfolios that you get, which are covered portfolios. If expiration occurs during the investment period, we didn't actually look at that explicitly, but it's in the simulations if you want to set that up. The only thing that happens for initiating positions is that this frontier comes down a little bit. But this is the frontier for the uncovered strategy, and these are for the covered strategies. So you can see this is definitely a better, for initiating a covered call strategy during an investment period. It's a good strategy. However, for ongoing strategies, if you have immediate exercise, which is not really the case, but if that were true, you would also have the covered call strategy being favored. And the reason for this is that as soon as your call goes in the money, if it's exercised, then the chances are that your slippage can be fairly low. And you can see that this position actually pays off. The more likely scenario, however, is that the exercise probability is less than 100%. And in that case, the covered call strategy is not favored. And the reason is that the very low maximum allowable slippage is likely to be breached. And as you can see, these are the efficient frontiers that you get. So our conclusion is that the covered call strategy is good for tactical purposes. If you're initiating a position in a covered call, that's actually it's a worthwhile thing to do, as long as you're not doing it in markets that are running away to the upside. But it's not so good as a long-term strategy. And if you're doing it day in and day out, and given the fact that the probability of early exercise is usually less than 1, it's not a good strategy at all. And what that means is the optimization is showing that if you have an ongoing strategy with a probability of exercise less than 100%, it's favoring the uncovered strategy, which means the covered strategy does as well or worse over the long term. And so we would expect that our returns for the covered strategy would pretty much match the underlying. And that's actually what we saw if we looked at the BXM index data. Now, just a couple of quick generalizations. You can use these tools in this approach to select portfolios of strategies. You can have scenarios for different strategies. It's sort of like a fund of funds approach. We can also relax a lot of the assumptions, things like introducing additional sources of randomness, although in many instances that doesn't really have a major impact, and adding more model detail. Another thing is to try different types of trading strategies. We were doing a fairly rule-based passive call writing strategy, but there might be some trading strategies that might be worthwhile. for this particular simulation, it would definitely be an improvement to have dividends on stocks incorporated in the models, possibly adding protected puts, which was a common feature of these types of funds, having naked options, which are usually prohibited, or to have other instruments, and so on. And then, of course, this actual architecture is ideally suited for the MATLAB parallel computing toolbox. So these are just some of the references that I used to prepare this webinar, and that concludes the webinar. And I just want to thank everyone. Thank you for listening, and I just want to make sure that you realize that these are all these scripts will appear on MATLAB Central, and these produce all the results that we had in this webinar today.